You have a superpower. You can control how you feel about situations. Our human brains have grown to the point where we get to override millions of years of baseline human instinct, which historically kept us alive, but in the modern day isn't the best way to handle the financial markets. Instead of getting angry or sad about the recent news of tariffs and its effects on our money or any other major market crash, which is a completely normal response by the way, we can choose to instead see the opportunity in the chaos. 50% of the market's best days happen during a bear market, and missing just 10 of them cost investors 50% of their portfolio's value. That's the difference between being a millionaire and being a 500,000-aire. Not only does it not sound as nice, the difference is an entire house, which is probably in a good school district too. The data is very clear. Staying invested, despite what our brains tell us, is the best strategy long-term if the goal is to increase our portfolio's value. Hi, I'm Raj. On this channel, we talk about money, and with the recent market volatility, I haven't sold anything. I want to warn you right up front, these 5 weird signs of market bottoms only happen when the markets are entering the opportunity zone, where we're able to pick up great assets at great prices. But this video is like that scene in The Matrix where Morpheus offers Neo the blue pill, where you can wake up and think all the events he's been through were just a dream, or he takes the red pill and leaves the Matrix. I'm not saying I can help you time the exact bottom of the market. I'm saying there are certain patterns of behavior that only occur during the best times to buy. Once you see it, you can't unsee it. And this video's main purpose is to help you override that part of your brain that tells you to panic sell and make less money, but instead do the opposite thing and buy and hold quality assets for the long term, because we're all incentivized for these numbers to go up. If you're still here, you chose the red pill. Why are you taking pills from strangers? This isn't Coachella. Number 1, the switch from wealth games to status games. A wealth game is very simple. The scoreboard is how much money someone has in their lifetime in a given year. It really doesn't matter. It's just a measure of money. How much money someone has, how much money someone made. A status game is measured by where someone sits in society. These are influential people in all areas of life. Politicians, musicians, actors, influencers, and yes, rich dudes on Twitter. So when everyone is losing money, meaning everyone is losing the wealth game, we see a switch to status games where people start attacking other people personally. So our first example, Chamath Palihapitiya, I'm sorry, I probably butchered that, is a billionaire venture capitalist, former senior executive at Facebook, and he made some comments recently on the market's movement. There was a politically charged element to this tweet, which got a response from Zach Weinberg, a founder of a couple of companies with significant exits, who said, "Man whose career accomplishment is taking a job early at Facebook and riding the market up says, do not look at the stock market because it's not a good measure of success." They had some more back and forth, but basically, rich dudes arguing on the internet is bottom of the market behavior. Another fun example, Dave Portnoy from Barstool Sports, questioning who would listen to a guy on Fox Business for looking like himself, talking about stocks, and then a comment from Benjamin Cohen from the crypto space, we're following by the way, commenting about Dave shilling meme coins nonstop 3 months ago. The wealthy guys are all losing money and switch to attacking people personally because the internet is just high school with billionaires. Number 2, Mount Rushmore speaks. So what do I mean by this? Mount Rushmore is a US national monument where 4 former presidents, Roosevelt, Lincoln, Jefferson, and Washington, are featured. These individuals were key figures in the nation's history. If we were to make a financial Mount Rushmore of today, a few people would be featured on the mountain. It doesn't really matter who is on the mountain, but rather the behavior of those people. When these people speak about market conditions in a very certain way, this is one of those weird signs a market bottom is in. I'm referring specifically to when major players in the finance space go online and post their long tweet. These are well thought out digital speeches on the current situation, bringing in their historical experience and what they're hearing from their positions today on the current situation. Bill Ackman, billionaire hedge fund manager, is a great example of this. And if you look at the timeline just a little while later, you notice 4 separate posts, all considerably shorter than his earlier long tweet market breakdown. The shorter post literally fit on one screenshot on my phone. Another great example, Ray Dalio, billionaire hedge fund manager, also had a long post regarding Trump's tariffs. These guys are busy and they got a lot of stuff going on. So if they take the time to post like this, it's usually to inform, educate, and keep people calm during a crash. They're also fund managers. So if people start panic selling their assets, they can't make any money because they have nothing to manage. So there is some personal incentive to do this. Number 3, we start hearing the phrase chess, not checkers, or even 4D chess. We start seeing people rationalizing the major market shifts and try to explain what's happening and why this is a good thing long term. I'm sure you've heard in past crashes, markets were over leveraged, or more recently, international trade was imbalanced for a long time, or even going back to the dot-com bubble where there were too many vaporware companies and they needed to be flushed out so quality companies could survive. Mark Tilbury has an excellent summary of recent events, and according to his post, the benefits of this chaos for Trump include negotiating leverage over trading partners, post-crash 10% rally lets Trump claim victory, increase in tariffs for China while framing Beijing as the single antagonist. That's just the 4D chess explanation. My peanut brain can't handle the 8D chess. I'm still trying to figure out the multiverse in the Marvel movies. Number 4, the everyone sees it coming moment. All this information and processing naturally leads to predictions. These are usually based on past historical market events. This time it was supposed to be Black Monday, referring to 1987, where the Dow Jones Industrial Average crashed over 20% in a single day. Instead, we got a rumor of a 90-day tariff pause, which led to a $3 trillion market move up. Then the White House denied that rumor, calling it fake news, which then led to a $2.5 trillion move down. This was 30 minutes on a Monday. When it was all said and done, no Black Monday happened. My portfolio just looked like a heartbeat on an EKG. I actually ended the day up from the market open. And number 5, the flight to boring. In up markets, we always see articles about how much money people made from some investment that is at the moment outperforming everything else in the markets. During these moves down, the natural response is to see how these safer, more boring investments are doing compared to the new kids on the block. One of those that I own personally is SCHD, and based on its construction, during times like these, we see articles mentioning how it's handling the move better than other investments. I'm sure it wouldn't be that hard to find articles comparing altcoins to Bitcoin, or even the S&P 500 or NASDAQ-based ETFs compared to other similar but slightly different options. For added context, in today's market, I decided to have a little fun and take this a step further just for research purposes. I asked ChatGPT to summarize the points in President Trump's book, The Art of the Deal, and apply it to what is happening to today's tariff news. The key points of the book were to think big, protect the downside, and the upside will take care of itself, maximize options, know your market, use leverage, enhance your location/assets, fight back, deliver the goods, play to people's fantasies, and have fun. Applying that to tariffs. This, of course, affects everyone across global markets, and ChatGPT goes further, saying it's a bold maneuver to reassert industrial and economic dominance globally, especially in critical sectors like EVs and tech. As far as leverage is concerned, the US sees its consumer market as a huge point of leverage. Tariffs restrict access to the market unless trade terms improve. As far as maximizing options by raising tariffs, the US increases pressure on companies to shift supply chains elsewhere, like Vietnam, Mexico, or the US. Playing to people's fantasies like bringing jobs home, rebuilding American manufacturing, or standing up to unfair practices, framing tariffs as defensive in terms of fighting back, appealing to the voter base concerned with economic nationalism and the erosion of American industrial power, which applies to knowing your market, and for protecting the downside, tariffs don't touch everything, only select industries. So our weird market bottom signs were the switch from wealth games to status games, financial Mount Rushmores, long tweets, chess not checkers, and rationalizing behavior, the everyone sees it coming moment, and the flight to boring, stable investments. And if you think we live in a simulation, Trump literally wrote a book about this past week. So now you're officially out of the matrix. Hopefully this will help you stay in the markets for the long term. Thanks for watching. I hope you enjoyed the video. Be sure to like and subscribe if you're interested in more content like this, and consider sharing this video with a friend. That really helps the channel out, and you get to help your friends out as well. I'll see you in the next video. Have a good one.